Okay, we will discuss some more theoretical part regarding this one. So till now we had studied or we had read that marginal cost means it is the additional cost when you are going to produce an extra unit of output with the existing output. So here it is not only treated as the extra one unit of output which is going to get produced and the extra cost to be incurred, but here another unit or a product line, if it is also getting added, then that extra cost for adding that product line also to be treated as the marginal cost for means adding that product line. So product line means, let's take for example, we were producing product X only. Now we want that product Y is very much profitable, so we have to shift and we have to produce that Y also along with product X. Then for producing product Y, the extra cost which is to be incurred along with product X, that extra is to be treated as the marginal cost for producing product Y. So marginal cost is not limited with one unit only. It can be also a product line or entire plant size. So in any form, you can also take this one. So here, acceptance or rejection of a decision also depends upon this marginal costing technique. So when you are taking a decision, so at that time you have to take the help of this marginal costing technique to decide whether the same project will get accepted or a particular alternative. If you are having to choose a decision you have to take, then which one to be picked and which one to be left, that you will decide depending upon the marginal costing technique. Okay, so I will be sharing the screen now, so you will be able to see that one. Okay, I think it is visible now.
Yes, sir.
Okay, okay, thank you. Okay, see here, it is relating to marginal costing and break-even analysis. So I think you might be having an idea relating to this break-even analysis technique. Yes or no? ଜାଣିଛ କି ନାହିଁ ରେ ବ୍ରେକ୍ ଇଭିନ୍ ଆନାଲିସିସ୍ ବିଷୟରେ? Okay, no responses. If you are replying in the chat box, then it will not be visible now because I have already shared the screen. So you have to reply whenever I am asking. So you have to reply only. So have you heard about this concept, break-even analysis?
Yes, sir.
Okay, so where you have heard about this particular concept, break-even? Sorry. Where?
Sir, in BCom.
Okay, as you all are belonging to this commerce fraternity, so you might be having an idea relating to this one. So it was also there in the management accounting or cost and management accounting part, CMA, in your become level or plus 3 level. Okay, so these two are linked with each other. So break even analysis and marginal costing. So you have to first know what is marginal costing, then you will shift to this break even analysis. So here the absorption costing and marginal costing both are not same. So what is marginal costing, what is absorption costing? In absorption costing, the entire cost is taken into account for taking a decision. That means both fixed and variable part will be taken together to take a decision. But in case of marginal costing, you are only taking the marginal cost, which is known as the variable cost, and it is also known as the relevant cost. So which one is relevant cost, the marginal cost or variable cost? Which is irrelevant, the fixed cost portion is known as the irrelevant cost. Why it is irrelevant? Because irrespective of your changes in production, you have to spend that one. If you had taken a house on rent basis, then whether you are going to stay there or not, at the end of each and every month you have to pay rent. That means it is not relevant now. Then what is relevant? If you are changing your production level, then how the variable cost is increasing. That means the decision part is always dependent upon the change part, not upon the static one. So here the marginal costing technique tells you that the variable cost is the determining factor which will find out how much profit you are earning and whether you are going to suffer from losses. Okay, so here marginal costing technique will identify or will tell you that the fixed cost is becoming irrelevant one. So next, coming towards the theoretical part. So concept of marginal cost and marginal costing. So the marginal cost term is defined as the amount at any given volume of output by which the aggregate costs are changed if the volume of output is increased or decreased by 1 unit. That means due to change in the total or entire output by 1 unit, it may be increasing or decreasing. What is the change you are means saying or changes you are finding in the total cost? So that is becoming the marginal cost. So I had already told you about that one. So in this context, the unit may be single article, a batch of articles, or an order, or sometimes it is a particular means quotation or order also we are telling about that one. So here it is not limited to a single article. Okay, so it can be also a batch or an order also, or for a single product line also. Product line means we were producing one product, now we want to add another product. Then the extra cost you are going to spend or incur, that becomes the marginal cost for adding another product line. Okay, so it is the variable cost of 1 unit of a product or a service. So here more specifically it is written, so it is the variable cost only, it is not the fixed part, so it is the variable cost. Next, for example, here for explanation point of view, it is written the cost of 100 articles is rupees 50,000, and that of 101 article, if it is being produced, then the total cost is reaching at 50,450 only. So what is the extra cost by, or it is increasing by changing the entire unit of production by 1 unit. So for 101th unit, you have to spend 50,450 minus 50,000 is equal to 450 rupees. So that is becoming the marginal cost for 101th unit of output. So 101 नंबर का जो आर्टिकल होगा और प्रोडक्ट होगा, उसका प्रोडक्शन के लिए जो ज्यादा खर्चा हुआ 50,000 के ऊपर, वो बन गया हमारा मार्जिनल कॉस्ट. तो उतना आ गया कि 450 आ गया हमारा मार्जिनल कॉस्ट. नेक्स्ट, so what is the theoretical part, or in equation term, if you want to know, then how you can find out the marginal cost? So here it is given. So or hence the total cost is the aggregate of fixed cost and variable cost. So we know that. So the cost structure, when we are going to segregate, then it can be segregated into two forms. One can be fixed, another one be variable. So after adding fixed cost plus variable cost, we will get the total cost. So if the production is increased by 1 more unit, then its cost can be computed as follows. That means there will not be any change in the fixed cost, only the variable cost will increase by 1 unit. So here you can see this one. So TCN means before increasing that one, increasing the production by 1 unit, what is the cost? So it is written here. So TCN is equal to fixed cost FC plus variable quantity. That means if we were producing 100 units, then 100 multiplied by the variable part. Then TCN plus 1. N plus 1 means the previous, if it is 100, then 100 plus 1. So the previous number of our existing level of production plus 1 unit, an extra. Then what will be the total cost? Fixed cost, it will remain constant, plus The variable cost for the previous quantity plus 1. So if the previous quantity is 100, then 100 plus 1. As it is not specified what is the number of particles, so we had written q plus 1, the quantity plus 1. Then by elaborating or removing the bracket, what we will get? Fixed cost plus vq plus v. Yes or no?
Yes.
Then we want to find out the difference between these two. So TCN plus 1 minus TCN, then it is for one extra unit. So FC plus VQ plus V minus FC minus VQ. So FC and VQ, it is getting cancelled. What is left? That is the V1. So V means MC is equal to V. So V means it is the variable cost only. So hence it is proved that the marginal cost is nothing other than the variable cost. So here we are arriving at our conclusion that the marginal cost is becoming the variable cost. Next, marginal cost is equal to the increase in total variable cost, because within the existing production capacity, an increase in variable 1 unit of production will cause an increase in the variable cost only. Okay, so which one I was telling you? So in the total cost part, as it is means combination of both fixed and variable parts. So when we are changing the entire production by 1 unit, so only the variable cost will increase, not the fixed part. So here it is written. So the fixed cost remains same. Next, in marginal costing, only variable costs are considered in calculating the cost of the product. Okay, so it is the basis of distinction in between variable or marginal costing and absorption costing. So while calculating the cost of the product, only the variable cost of the product will be taken for calculating the cost of the product. But in absorption costing, both fixed cost and variable cost is taken. Okay, so while calculating the value of closing stock, here in marginal costing, we are only taking the variable cost. On the basis of variable cost, what is the cost? But in case of absorption costing, both fixed cost and variable costs are taken to find out the closing stock value. Okay, next, while fixed costs are treated as period costs, here it is written period costs, which will be charged against the revenue of the period. Next, the revenue generated from the excess of sales over variable cost is called as contribution. That means here we are finding another name or terminology known as the contribution part. Then what is this means? So contribution means here it is the excess of sales revenue over and above the variable cost. So sales minus variable cost, whatever is left, this is known as the contribution margin, or this is the gross margin. So you have to remember the name. So contribution margin means it is the gross margin. So we are going to deduct the variable cost out of the sales proceeds and reaching at contribution part. Then after deducting the variable cost, we are arriving at our contribution. Then fixed cost is not deducted. So how to find out the profit part? After contribution will be found out, we will deduct the fixed cost to find out profit. So what will be our marginal costing equation? So marginal cost equation, you can write it down. In the top, you write sales. Just write it down. So in the top, write sales, then its amount. In cross mark, you symbolize that one. So in cross type, you can write down that one. So sales is equal to something less variable cost, VC, variable cost is equal to, again cross mark. Symbolically, you have to write the cross marks. Next, by deducting out of sales, variable cost will get deducted and we will get contribution margin. Okay, so write sales minus variable cost is equal to contribution. Okay, or gross margin, bracket में लिख लो gross margin. Next, less fixed cost, less fixed cost, नीचे से नीचे नीचे करके लिखो, less fixed cost is equal to profit. Profit or loss, profit or loss. That means If your fixed cost is greater than contribution, then loss will come. But if fixed cost is less than your contribution, then there will be profit. Your gross margin is exceeding your fixed cost, then profit will be there. But if your gross margin is less than the fixed cost, then cost is exceeding your gross margin, so there will be losses. So you have to remember this particular means entire equation. It will be of a great help in future. Okay, next. Mathematically, how you are going to find it out? So whatever I had told you, here it is written, okay, in equation term. So total sales minus variable cost is equal to contribution. Sales is equal to variable cost plus contribution. तो वेरिएबल कॉस्ट सेल्स से डिडक्ट करने के बाद हमें मिलता है कंट्रीब्यूशन, या हम कंट्रीब्यूशन में अगर वेरिएबल कॉस्ट ऐड कर देते हैं साइड चेंज करके, ओके, तो हमें टोटल सेल्स मिल जाता है. उसके बाद अगर हम फिर से वेरिएबल कॉस्ट और सेल्स के साथ कंट्रीब्यूशन को कंपेयर करते हैं, कंट्रीब्यूशन के अंदर क्या क्या आ गया, फिक्स्ड कॉस्ट, और उसमें हम प्रॉफिट ऐड कर सकते हैं या लॉस डिडक्ट कर सकते हैं. तो फिक्स्ड कॉस्ट प्लस माइनस प्रॉफिट और लॉस इज इक्वल टू सेल्स माइनस वेरिएबल कॉस्ट. सो ये हो गया एक इक्वेशन. नेक्स्ट, अगर कंट्रीब्यूशन के अंदर आ गया हमारा फिक्स्ड कॉस्ट प्लस माइनस प्रॉफिट और लॉस, देन प्रॉफिट और लॉस इज इक्वल टू क्या होगा, अगर पहला बार हम लिख रहे हैं प्रॉफिट इज इक्वल टू कंट्रीब्यूशन से फिक्स्ड कॉस्ट निकाल देंगे, और लॉस अगर जानना चाहते हैं तो क्या करेंगे, कंट्रीब्यूशन में ऐड कर देंगे फिक्स्ड कॉस्ट. ओके, सो इट विल बी आवर लॉस. सो these are the total of the equation type of explanation. Okay. Loss is equal to contribution plus fixed cost, or profit is equal to contribution minus fixed. हो गया. सो यहाँ पर लिखा गया है, एग्जाम्पल के तौर पर दिया गया है. सो द सेलिंग प्राइस ऑफ ए प्रोडक्ट इफ इट इज 30 per unit and its variable cost is 20, then after deducting variable cost out of sales we will get the contribution. So contribution will be 30 minus 20, it is rupees 10. So it is a simple one, so you can remember that one. Then what is profit volume ratio? So PV ratio, it is one of the important ratio which will determine your earning capacity of a business. So this PV ratio is a ratio which will identify the relationship between your sales and the earning part. So profit and volume. So sales and profit both are to be judged here. So here profit means here contribution will be taken into account, and volume means here sale. So PV ratio is equal to contribution by sales. Okay, so a percentage term, if you want to find it out, multiply by 100. Okay, लिखिए प्रथमे ताहले. सो लिख लो, पहले लिख लो ये वाला, PV ratio is equal to contribution by sales into 100, C by S into 100. नेक्स्ट नीचे लिखो. सो कंट्रीब्यूशन का मतलब क्या आ गया, सेल्स माइनस वेरिएबल कॉस्ट. सो सेल्स माइनस वेरिएबल कॉस्ट होल डिवाइडेड बाय सेल्स. कंट्रीब्यूशन के जगह पर हम दोनों को लिख लिए. सो सेल्स माइनस वेरिएबल कॉस्ट होल डिवाइडेड बाय सेल्स. तो अगर इंडिविजुअली हम डिवाइड कर देते हैं तो सेल्स बाय सेल्स माइनस वेरिएबल कॉस्ट डिवाइडेड बाय सेल्स. इसका मतलब ये हुआ सेल्स बाय सेल्स का मतलब 1 माइनस वेरिएबल कॉस्ट बाय सेल्स. तो यहाँ पर हम और एक भी लिख लिए हैं, 1 माइनस वेरिएबल कॉस्ट डिवाइडेड बाय सेल्स. इट विल बी ऑल्सो योर पीवी रेशियो. नेक्स्ट, अगर हम वेरिएबल कॉस्ट और सेल्स उन दोनों को ना मीन्स उन दोनों को दिखाने के बदले और कुछ दिखाना चाहते हैं, इसका मतलब उसके बदले हम ले लेते हैं कि नीचे वाला पार्ट जो हो गया फिक्स्ड कॉस्ट प्लस प्रॉफिट और फिक्स्ड कॉस्ट माइनस लॉस. फिक्स्ड कॉस्ट से लॉस हम अगर हम डिडक्ट कर देते हैं हमारा कंट्रीब्यूशन आ जाएगा, या हमारा जो प्रॉफिट पार्ट है उसमें अगर फिक्स्ड कॉस्ट जोड़ लेते हैं तो हमें कंट्रीब्यूशन मिल जाएगा। तो दोनों को मिलाकर डिवाइडेड बाय सेल्स करने से भी हमारा आ जाता है। और उसके बाद ये वाला है इंपॉर्टेंट, बहुत सारे क्वेश्चन में ऐसे भी दिया जाता है कि तुम्हें कोई भी इंफॉर्मेशन ऐसे दिया नहीं जाएगा कि सेल्स कितना है, वेरिएबल कॉस्ट कितना है, ये सब नहीं दिया जाएगा। तो क्या दिया गया होगा कि 2 साल का सेल दिया गया होगा, ओके, और कंट्रीब्यूशन भी दिया गया होगा, ओके, वेरिएबल कॉस्ट के बदले तुम्हें कंट्रीब्यूशन दिया गया होगा। तो कंट्रीब्यूशन पर यूनिट इज दिस मच and sales is this much. Then you have to apply a formula, change in contribution by change in sales. Okay, so this is the formula you have to remember. So change in contribution by change in sales will also give you the PV ratio which is required for finding out the BEP, break even point. Okay, so this PV ratio will help you in identifying the break even margin. That means where you are having a point where you are not incurring any losses or you are earning a profit. So it is the means equilibrium point where no profit, no loss will be there. So it is known as the break-even point. Okay. Next, instead of using this change in contribution by change in sales, you can also apply the formula change in profit by change in sales. So these are the various alternatives. Depending upon the given information, you have to apply any one formula. Okay. Next, here one formula is given for break-even analysis. Then what is break-even analysis? So you have to first know what is break-even analysis. So break-even analysis means, break-even point means, first you know, this is a point where the company neither earns profit nor suffers from any losses. So this is known as no profit, no loss point. Okay, so break-even point means no profit, no loss point. It is the point where the revenue equates with the cost. So cost and means revenue both are equal here. So the company is not earning profit, nor it is suffering from losses. So how to find out the means area or the particular point where the cost will be equating with the revenue. So here are some formula, so you can apply that one. So first formula is fixed cost by contribution per unit, the total fixed cost divided by contribution per unit. Contribution per unit means what? So total per unit total selling price minus variable cost per unit, you will get contribution per unit. So sales price per unit minus this variable cost per unit will give you the contribution margin or contribution per unit. And after dividing contribution per unit with the fixed cost per unit, sorry, per unit, fixed, total fixed cost, it will be in means 1 lakh, 2 lakh, 3 lakh, 10,000, 15,000. It will be the total entire fixed cost. The total fixed cost divided by contribution per unit will be your break-even point. So here, when you are applying this particular formula, so fixed cost divided by contribution per unit, you will get in unit term. Okay, so here it is written break-even point in units. So here you will find out the quantity, the number of units to be sold to attain break-even point. That means to reach at a point where the profit will not be there or loss also will not be there. So revenue will be equal with the cost. Then if you want to find out in sales volume, that means in rupees, you want to find out the break even point in rupee term. Okay, so टोटल हमारा जो पैसे के तौर पर कितना आ गया, तो हम क्या करेंगे, जितना भी पर यूनिट आया है उसमें हम मल्टीप्लाई कर देंगे सेलिंग प्राइस पर यूनिट, तो हमारा आ जाएगा टोटल इन सेल्स वॉल्यूम, और वी कैन अप्लाई व्हाट the same formula here it is written. So see, fixed cost divided by sales value minus variable cost. So it is fixed cost divided by contribution multiplied by sales value. Okay, so sales value means the sales value you can find it out, sales value per unit. So after multiplying that one, you will get the break even point in rupee term. Okay, next, also you can find out break even point by taking the help of PV ratio. Okay, PV ratio means contribution by sales. So this PV ratio will be divided with the fixed cost to find out the break even point. Okay, so here it will come in sales volume. Okay, so rupees टर्म पर आ जाएगा ये. So अगर फिक्स्ड कॉस्ट 10 लाख है और पीवी रेशियो 50% हो गया, तो इसका मतलब ये हो गया कि हमारा जो बीईपी है 10 लाख डिवाइडेड बाय 50%, तो हो जाएगा 20 लाख. ओके, सो ऐसे ही हम निकाल सकते हैं. तो ये हो गया हमारा ब्रेक इवन पॉइंट का फॉर्मूला, और ये सब यूज करके हम निकाल सकते हैं हमारा कितना होगा ब्रेक इवन पॉइंट, कितना होगा हमारा पीवी रेशियो, और हाउ टू फाइंड आउट द different on given informations. Some means unknown informations will be there which you have to find out depending upon the marginal costing equation. We will also do some sums related to that one. Okay, next, here it is a question which is given, so you are, it is visible.
Yes, sir.
Yes, sir.
Okay, see here it is written, you are required to calculate break even point in the following case. So you have to find out the break even point. The fixed cost for the year is 80,000. So the total fixed cost is given 80,000 rupees. The variable cost per unit for the single product being made is 4. So variable cost per unit is rupees 4. Estimated sales for the period are valued at 2 lakh rupees. इसका मतलब ये हुआ कि टोटल जो सेल्स है हमारा हो जाएगा 2 लाख. The number of units involved coincides with the expected volume of output. Each unit sells at 20. इसका मतलब क्या हुआ, जो सेलिंग प्राइस पर यूनिट है ₹20, तो हम कितने सेल्स करके हम 2 लाख का अर्निंग करेंगे, 2 लाख डिवाइडेड बाय 20, इट इज कमिंग 10,000 यूनिट्स. Okay, so calculate the break even point by applying the important formula. So what we are going to do, sorry, we are going to apply the necessary formula and find out how much will be our break even point. Okay, so who can calculate this one? Anyone? Okay, let me show you. So here it is given.
Sir, answer 1 lakh. Sir, answer 1 lakh.
Yes, 1 lakh, it is correct. Now you can see the answer. So see here, the sales is rupees 20, okay, minus variable cost rupees 4, so contribution per unit is 16, and the total entire contribution is 1 lakh 60. Minus fixed cost is given 80,000, and the remaining profit is arriving at 80,000. That means when our sales is 2 lakh, our profit is arriving at 80,000. That means we have to find out a sales where our profit will become nil. Okay, it is zero. No profit, no loss. So to identify that one, we have to apply the formula. So here we had a formula like this one. I'm showing that one. So this is here. So fixed cost into sales value divided by sales value minus variable cost. So we had applied that one. So fixed cost, here it is 80,000 into sales value 2 lakh divided by 2 lakh minus variable cost is how much? Here it is there. Variable cost is 40,000 only. Okay. So here we had applied that one, 80,000 multiplied by 2 lakh divided by 2 lakh minus 40,000. Okay, so it's coming 1 lakh. So 80,000 multiplied by 2 lakh divided by 1 lakh 60,000. So here 1 lakh 60,000 and 80,000, it will be cancelled and the denominator will be 2. So 1 lakh, 2 lakh divided by 2 is equal to 1 lakh. So we have to check that one. So put 1 lakh here. The sales will be 1 lakh. and variable cost will be 4. That means the variable cost per unit is 4. Okay, so if it is 1 lakh, that means 20 is the per unit selling price. So the number of units to be sold, it is 5,000. So 5,000 multiplied by 4, it is 20,000 will be the total variable cost. So out of 1 lakh, 20,000 gone, then 80,000 will be your contribution, and fixed cost is here 80,000. So fixed cost will not change. So 80,000 minus 80,000. What is left? Nil or 0. So in this way, you can justify that whatever amount I had got, whether that is correct one or not. Okay. So here, BEP also you can find out by applying the formula, the fixed cost divided by PV ratio. PV ratio, how to find out the PV ratio? Contribution by sales. So contribution is here 1 lakh 60 divided by sales is 2 lakh. So 1 lakh 60 by 2 lakh means 80%. Okay. So here BP is equal to 80,000 divided by 80%. Okay, it is coming 1 lakh.
सर वो जो क्वेश्चंस आएगा उसमें क्या वो लिखा होगा कि मतलब पीवी रेशियो अप्लाई करना होगा या मतलब
नहीं
हम
नहीं नहीं
जैसे
नहीं,
जैसे कर
डिपेंडिंग,
सकते हैं वैसे कर
हाँ
सके?
हाँ हाँ, वही जैसे चाहो कर सकते हो, मगर ऐसे भी कुछ इंफॉर्मेशन होगा जैसे कि तुम्हें एक ही फॉर्मूला अप्लाई करने के लिए वो सही होगा। ओके, जैसे कि हमारा होता है कि हम डिजायर्ड प्रॉफिट का जो फॉर्मूला हम ऐड करते हैं, फिक्स्ड कॉस्ट प्लस प्रॉफिट इज इक्वल टू कंट्रीब्यूशन, कंट्रीब्यूशन बाय सेल्स इज इक्वल टू पीवी रेशियो। सो वहां पर हम अप्लाई करते हैं फॉर्मूला क्या, कि हमारा जो पीवी रेशियो होता है वहां अगर हम डिजायर्ड प्रॉफिट जानना चाहते हैं तो हाउ मच प्रॉफिट इट हैज टू अर्न to achieve this much of profit or to achieve break even. At that time, you have to apply that particular formula. Fixed cost plus minus profit divided by sales is equal to PV ratio. So you can't change that one. So depending upon the given information, you have to apply the formula. But if there are means many alternatives are available, then you can apply any one. So it is an open-ended question. So you can apply more than one formula. Then it is upon you which formula to pick. Okay. So next, I'm showing you some other parts are there. Important. Okay, see here. So I am dictating that one. So here these are the means out of your study material I had picked this one. So here the segregation of mixed cost. Mixed cost means both fixed and variable cost. Its segregation. It is there in your syllabus in your unit 15. Then concept of marginal cost and marginal costing, we had read that one. Then income statement under marginal costing and absorption costing. So it is there, and let me show you that one. Income here, okay, income statement under marginal costing and absorption costing. So what is the basic distinction between these two? Under marginal costing, only the marginal cost is taken into account for decision making purpose, and in absorption costing the entire cost is taken, both fixed and variable. Okay, but in marginal costing only the variable part is taken into account. So next, here it is given. It is very easy, you can get it. So here it is written, given, that means what are the informations given. Okay, production 1 lakh units, sales is 90,000 units at the rate of rupees 3 per unit. Okay, so production is 1 lakh, sales is 90,000. That means what it suggests, it is showing that out of the entire production, total is not sold. So there is some unsold stock in our hand at the end of the year. So 1 lakh unit, out of which 90,000 is sold and 10,000 units still it is lying as unsold. Okay. Next, variable manufacturing cost is given rupees 2 per unit. Okay, that means whatever production it is there per unit, we have to spend rupees 2 as manufacturing cost. This is variable. Next, fixed overhead cost, it is also there. It is fixed at 50,000 rupees. Then selling and distribution cost, it is given 10,000, of which 4,000 is variable and remaining 6,000 it is fixed. So prepare income statement under marginal costing and also under absorption costing. That means in case of marginal costing, it tells you that the variable cost is only the relevant cost and it will be taken into account for calculation purpose. But we will not take into account the fixed part. Fixed part means here we are not going to take the fixed overheads 50,000 and here the selling and distribution cost fixed portion, that is 6,000. So 56,000 we are not going to include while finding out or explaining the concept of marginal costing. So income statement under absorption costing, you can see here under absorption costing, sales, it is 90,000 multiplied by 3, it is 2,70,000 less manufacturing cost is how much? Variable cost is 2 multiplied by 1 lakh units, 2 lakh. Then fixed overhead, we will take everything into account because it is absorption costing, both fixed and variable will be taken into account. So here 50,000 is also there. So total 2,50,000 less closing stock. How to value this closing stock? Closing stock means here for 1 lakh unit, the total cost which is spent, that is 2,50,000. So 2 lakh plus 50,000. Then for 1 lakh unit, if it is 2,50,000 it is spent, then for 10,000 is how much? Okay, so 10,000 remained unsold. So that is the valuation of unsold or closing stock. Okay, so here we are finding out it is 25,000. So the entire part we are getting after deducting out of the sales, we will get 2,25,000 will get deducted and we will get gross margin. This is 45,000. 2,70,000 minus 2,25,000, it is 45,000 less. Selling and distribution overhead is also there. So its cost is how much? That means it is given 10,000. So including fixed cost 6,000, variable 4,000. No segregation will be made because everything will be taken into account. So here 10,000 is taken. So whatever is left, that is the profit or loss. So as surplus is there, so it is becoming profit. So 45 minus 10, it is becoming 30,000, 35,000 profit. Next come to this marginal costing part. So see here, sales is 90,000 units at the rate of 3 per unit. So 2,70,000. Then see, variable manufacturing cost. So only 1 lakh multiplied by 2 is taken. Fixed cost is not taken into account. Okay, so here it is becoming 2 lakh only. Next, less the value of closing stock is also valued at the variable cost only. No fixed cost will be included. That means 2 rupees per unit. So 2 multiplied by 10,000, 20,000 is becoming the closing inventory value. So what is left? That is 1,80,000. So add variable selling and distribution cost only. So it is 4,000. So 1,84,000 will get deducted. And whatever we got, that is the contribution margin. Okay, so contribution margin is how much? 86,000. It is known as the gross margin. Less fixed cost. Fixed cost is how much? Here fixed overhead is 50,000 and fixed selling and distribution is 6,000. Total is 56. So whatever is left, it is our profit. So how much we have got? So 30,000. But in earlier case, how much we got? So that is 35,000. Why such differences came or it has arisen? So due to the valuation of closing stock. So closing stock is valued only, means in under our absorption costing, it is valued both by including fixed and variable. But here in marginal costing, only the variable cost part is taken into account. So due to which the closing stock is valued earlier at 25,000, Now under marginal costing it is 20,000. So 5,000 difference is seen here. So here profit is 30,000, but earlier the profit was 35,000. Hope you all got it.
Yes, sir.
Okay. Next. Okay, next, which one is relevant and important? I'm showing you that one. Okay, PV ratio, we had already read that one. Marginal managerial uses of marginal costing, limitations of marginal costing. Okay, some of the limitations I am going to tell you. Okay, so this marginal costing equation and contribution margin, we had already read that one. Another one. So you can write it down. Angle of incidence and margin of safety. These are the most important one here. So what is margin of safety and what is angle of incidence? Just write it down. Angle of incidence and margin of safety. Okay, first write margin of safety. So what is margin of safety? So here the name is suggesting everything. So safety margin means it is the excess of actual sales over and above the break-even sales. Okay, so you can write it down. So excess of actual sales over and above the sales at BEP, break-even sales. Okay, so sales which is actually it has been affected by the person concerned minus sales at BEP. So that will give you the margin of safety. That means beyond the means BEP point, whatever profit you want to attain, it will be identified by deducting only the variable cost, because fixed cost has already got absorbed. So only we have to deduct the variable cost and the remaining part is profit. Okay, so after attaining the BEP, so all the excess of variable cost is profit. No fixed cost will be taken into account, because fixed cost plus variable cost we have reached at the BEP point. The total entire fixed cost got absorbed. Okay, so one of the assumption is there in our marginal costing that the fixed cost is remaining fixed during the entire production process. Okay, so it is not changing. So if it is a subject of change, then such type of thing will not be there. Okay, next. So how to find out this margin of safety? Write down the formula. Whatever we had written, that will be written in the formula part. Okay, so actual sales minus sales at BEP, or another formula is there, profit by contribution per unit. Profit by contribution per unit. Profit by contribution per unit. This is the margin of safety in unit. Okay, so in unit term, if you want to find out how much the excess of sales above and over and above the BEP sales, then it can be found out by applying the formula, that is profit by contribution per unit. Or if you want to find out in sales value, means in rupees, then another formula will be applied, that is known as profit by PV ratio. Profit by PV ratio. Okay, these portions we had already completed. PV ratio also we had discussed all these. Okay, this is the graph. You can see this one here. Okay, here this is the BEP. Okay, see this one. So if this is the representing the sales part, okay, cost by revenue, and here it is represented by this particular graph, and this is the contribution margin, contribution line. Okay, contribution means sales minus variable cost, and this is the sales volume. Then how much is our profit? How to identify? If this is the BEP sale, then above this BEP, okay, so all the sales over and above this BEP is known as the margin of safety. And out of this margin of safety, if we are deducting the variable cost, we are getting the profit part. Okay, so below the BEP, okay, below the break-even point, the area is known as the loss region, because till that point we had not covered our fixed expenses. So if we are reaching at break even point, that means our fixed expenses got covered along with the variable part. Okay, so this is the graphical representation one. So here you can see, okay, managerial uses. Okay, this is the most important one. So if you want to means cover the entire part of this managerial uses of this marginal costing, then you will certainly get a particular question out of this. So what are the various uses? Why this marginal costing technique is used? So for price fixation part, if you want to fix a selling price, what is the desired selling price? If you want to achieve 10% profit upon your means cost, then what will be your desired profit? Then accepting special order and exploring additional market. If you want to accept a special order, an order is coming, a quotation has been received from a customer. Okay, so a bulk order you have received. Whether accepting that one will be profitable, or by not accepting that one, rejecting that one, it will be profitable. So for deciding that one, you will apply this marginal costing technique. Okay, so an analysis will be made and we will find out whether it is profitable or not. Next, exploring additional market. If you want to enter into an extra market, you are operating, let's take for example, in Odisha's different markets you are means operating. Now you want to explore to another one, Andhra market, you want to enter that one. Then whether entering into these markets depending upon all the given circumstances, all the circumstances means all the conditions it will be dealt with, it will be taken into account, then an analysis will be made whether entering into that market is profitable or not. Okay, next, profit planning. This is as regards to desired profit. So all the questions one by one you will practice, then you will get that what are the questions it will come, or possible questions it will come in the examination. So profit planning at that time, the means formula, this one profit which one, contribution is equal to means fixed cost plus profit. So that particular formula will be applied here. So fixed cost plus profit, desired profit divided by sales is equal to PV ratio. Okay, so that particular formula will be applied here to find out or to make this profit planning part. Next, key factor or limiting factor. What is key factor or limiting factor? Key factor means in each and every organization there will be certain factors which are very rarely available. due to the existence of that particular factor, that particular person, the organization is earning a huge revenue. If that particular factor will not be there, then the organization will be suffering from losses. Then identifying that one and using that one is a problem of choice. So how to do that one? There are problems. You can also go for that one. Then sales mix decision. Sales mix means if there are more than one products available. Let's take for example, A is there, B is there, C is there. Then what is the optimum mix? Whether 30 percentage of A, 40 percentage of B, and 20 percentage of C, and remaining 30 percentage of B. In this way, or D, it will be mixed, and we will get an optimum sales mix, and it will be more profitable. Or more of A, less of B, and lesser of C, then comparatively higher of D. In this way, you have to find out the mixed one. So different probable or possible mix you have to prepare, and out of all these, you have to find out which one is the best mix. So that is known as the sales mix decisions. Next, make or buy decision. It is the one of the most important decision which you have to take. So what is make or buy decision? That means sometimes it happens that a producer will be thinking whether if I am getting a particular order, then I will buy that from market and supply to the customer, or I will produce that of my own in my own factory and then I will supply to my customer. So making in our own factory and supplying, or I will buy from anywhere else and supply. Which one will be more beneficial? Okay, see here, I am giving you a very easy formula to identify which one is beneficial. So always remember, if your variable cost part, okay, so if your variable cost part is or when you are producing, okay, so the total variable cost, it is greater than, it is more than the price which is available in the market, okay, then in such case you will buy from the market. Why? Because your own cost is exceeding the market price, the variable cost. Along with the variable cost, you have to also incur some fixed expenses. That means the price will be a huge one. But if your variable cost is below the below the market price, that means if variable cost is 5 per unit but market price is 6 per unit, then in such case analysis is to be made. That means what? If the total products or number of units you are going to supply is 10,000, take for example. Okay. So from market, if you are going to purchase, then 6 rupees per unit, 60,000 it will cost. But if you are producing of your own, then 5 rupees will be the variable cost. Then the total variable cost will be 50,000. Let's take for example, the fixed cost is 5,000. Then you are going to earn extra 5,000 profit if you are producing of your own. But if you are purchasing from outside, then you have to incur 60,000. But if you are producing, you have to spend 55,000. So here you have to make a particular analysis whether we are going to buy from the market and supply, or we are going to produce and supply. Okay, so these are the various decisions or managerial uses of marginal costing technique. Then another one is there, adding or dropping a decision. That means out of all the product lines, all will not prove to be profitable. So in such case, we will choose a particular one which will be profitable, it will be continued. And if a loss making product line is there, which is continuously losing, then in such case, it will be dropped out. That means it will be discontinued and no more it will be produced in the factory itself. That means whether a product will get added or it will be dropped out or it will be discontinued, that also been determined by this marginal costing technique. So these are the various parts, or these are the managerial uses which will be having different types or categories of problems. 8 types of problem you are going to get. Okay, so suspension of activities also. So and a capital budgeting decision is also there. Okay, so whether to purchase a car or have a rented car, it is not there, so you have to add that one also. It is also sometimes there. You can also find out the same problem in your old books also. Capital decisions also you can take depending upon the marginal costing technique. So these are the various uses of this marginal costing technique. So today we had read about this marginal costing technique. What is marginal cost? Its concept, then various problems related to marginal cost and BEP, the concept of BEP, then PV ratio, and also the margin of safety. Okay, so thank you for today. Hope you all had enjoyed all the classes. So I will be sharing the slides which I had prepared in your group. So if you have any doubt, then you
Okay,
can
sir.
also consult. So thank you for today. Thank you everyone. So I will share all the slides. Okay. So thank you.
Thank you, sir. Thanks a lot.
Thank you, sir.
Okay, okay. You are most welcome.